They told you the bull run was finished. They told you the year-end dump was the reset and that everything dangerous had already happened. But here is the reality the screen is finally confessing. This market is no longer being priced by charts. It is being priced by power, by shipping lanes, by sanctions, by weapons, by which nations can still secure what they need and which nations are about to learn what scarcity feels like. As this week opened, silver did not crawl higher. It snapped higher like a rubber band released in a vacuum, pushing into the high 70s as safe haven demand returned with force. Reuters reported spot silver jumping again as Venezuela turmoil and rate cut expectations pulled capital into metals, with spot silver quoted around $78 per ounce and spot gold around $4,463 per ounce. The numbers matter, but the reason matters more, because the reason tells you whether this move fades or whether it becomes the kind of repricing that rewrites portfolios and ruins anyone who stays complacent. My name is Marcus Blackwell. I am not a financial advisor. I study financial systems the way a historian studies empires. I watch the repeating patterns most people only recognize after they lose purchasing power. I do not dramatize the future. I expose its structure. And the structure right now is screaming that we have entered a phase where the war premium is back. The physical market is separating from the paper market, and the institutions are repositioning for a world where stability is not guaranteed. Over the weekend, the geopolitical floor shifted. Multiple major outlets reported that United States forces carried out an operation in Venezuela that removed Nicolas Maduro, with international backlash escalating immediately. Reuters reported the United Nations Human Rights Office criticizing the intervention as a violation of international law and warning it sets a dangerous precedent, while also noting that Maduro faces criminal charges in the United States and that an interim leadership arrangement was announced inside Venezuela. Al Jazeera described the operation and the global outcry in real time as Maduro appeared in court in New York and pleaded not guilty. Whether you agree with any side politically is irrelevant to the market. Markets do not vote. Markets calculate. And the calculation is simple. When a superpower demonstrates it is willing to use force inside an energy-rich nation, the global system hears a single message. Resources are no longer just traded. They are contested. That is the moment investors stop treating metals as a hobby and start treating them as insurance. This is why the rally began before New York even woke up. It did not start with the opening bell. It started the instant electronic trading opened because smart money does not wait for confirmation. It front-runs risk. When the headlines hit over the weekend, the first wave of buying was not emotional. It was operational. It was risk desks and macro funds and hedgers moving before liquidity returned, forcing price to leap upward to find sellers. In war-driven markets, sellers disappear because nobody wants to be short the one asset the world runs to when trust breaks. That gap is not just a chart pattern. It is a trap door. Anyone who stayed short into the weekend woke up underwater. And when a trader is trapped, the market does not need persuasion. It gets fuel from forced covering. But do not make the mistake of thinking Venezuela alone did this. Venezuela lit the fuse. The explosive material was already packed tightly beneath the floorboards, and that explosive material is structural scarcity and international arbitrage. While the West watches headlines, the East watches inventory. The most under-discussed fact in this entire move is that the physical price in Asia has been running ahead of the Western paper price, and the gap is not closing the way a healthy market would close it. The Shanghai Gold Exchange publishes an official Shanghai silver benchmark price each trading day, and those benchmark updates show elevated pricing and tightness that has not been resolved through normal flows. This is what I call the Shanghai vacuum. In a normal world, if Shanghai bids higher and New York bids lower, bullion banks and refiners buy in the cheaper market and deliver to the higher market until the spread collapses. That is what arbitrage is supposed to do. But when the spread persists or widens, it means one of two things. Either physical supply cannot move fast enough to satisfy demand where it is needed, or the cheap price is not truly available in size because it exists as paper. Either way, the result is the same. Metal flows east, and the West is left with receipts. This matters because silver is not just a monetary metal. It is an industrial input. It is a strategic material. In a world that is militarizing and electrifying at the same time, silver demand becomes doubly reinforced. Gold is the general in times of fear because it is pure monetary insurance. Silver is the shock troop because it is monetary insurance and industrial necessity at once. That is why silver can outperform gold when chaos rises, because it gets a safe haven bid and a supply chain bid simultaneously. Reuters captured that dynamic this week by tying the jump in metals not only to geopolitical stress, but also to expectations around monetary policy, a combination that tends to accelerate flows into hard assets. Here is where it gets crazy. The war premium does not just increase demand. It changes the psychology of national resource holders. When one resource-rich country becomes a battlefield, every other resource-rich country starts asking whether they will be next. And when governments feel that pressure, they tighten export policy, rewrite royalties, and treat metal like strategic inventory rather than commercial inventory. That is how supply shocks are born. Not because the ground runs out, but because politics interrupts the pipeline. This is why traders pay a premium today. They are not buying because they fear missing a line on a chart. They are buying because they fear not being able to source metal tomorrow at any price. Now layer in the bank positioning, and you get the third engine. In late December, a familiar pattern played out. Aggressive selling into thin liquidity to manage year-end exposure. Banks with large precious metals desks and large derivative books have incentives to reduce reported risk going into reporting dates. They do it by pushing prices lower, shrinking the visible mark on their positions, and resetting the options landscape. Then they attempt to reload quietly in January. That game works until reality interrupts it. This week, reality interrupted it. As prices surged back, the short side faced margin pressure, and the options side faced gamma pressure. Once silver pushed above key psychological levels, the stop orders above those levels turned into market buys, and dealer hedging turned into additional futures buying, creating a feedback loop that amplifies every fundamental impulse into a vertical move. That mechanism does not require conspiracy. It requires math. And math does not care what anyone believes. Now add the harshest detail of all. In prior cycles, banks could cap spikes by sourcing physical bars, leasing supply, and flooding the market to cool price. But if the Shanghai vacuum is draining available inventories and if physical demand is being pulled into Asia, that escape hatch narrows. When paper sellers cannot access enough real metal, paper stress builds, and stress always resolves in the direction of the scarce thing, which is the metal itself. The brutal truth is that the screen price is becoming a weaker thermometer for the physical trade. It still matters, but it is increasingly a paper benchmark that must eventually reconcile with the street price, where manufacturers and sovereign buyers are actually clearing volume. That is why you should not look at a green candle and assume silver is expensive. You should ask one question: is physical tightness rising or falling? Because if tightness is rising, today's price is not a peak. It is a waypoint. And that brings us to the next wave. January allocation. Every year, the slow giants move. Pension funds, sovereign wealth funds, endowments, insurance portfolios, they deploy New Year capital. When they change direction, it is not a trade. It is a multi-year shift. Reuters pointed to rate cut expectations influencing metals. And that matters because falling rates reduce the opportunity cost of holding non-yield assets like gold and silver, making institutional committees more comfortable increasing exposure. But the deeper driver is that the traditional stock and bond playbook has been failing under persistent inflation risk. When inflation remains sticky, bonds can become a guaranteed loss in real terms. Institutions respond by seeking assets linked to real-world scarcity and industrial necessity. Silver sits at the crossroads of both. It is monetary, and it is required for electrification. This is why the phrase climate solutions has quietly become a commodity demand engine. Solar build-outs, grid upgrades, and industrial retooling requires silver. And if a small fraction of institutional capital reallocates toward real assets, the volume can overwhelm annual mine supply because the silver market is not sized for pension-scale flows. This is where the ETF mechanism becomes dangerous. When institutions buy large blocks of silver exchange-traded funds, authorized participants are supposed to source physical bars to create new shares. If sourcing becomes difficult, premiums appear, inventories tighten further, and the market becomes more fragile. In a fragile market, shocks produce gaps. In a gapping market, leverage dies. That is why survival matters more than excitement right now. I cannot stress this enough. If you are trading silver with heavy leverage, margin, short-dated options, you are walking into a zone where volatility is designed to remove you. In parabolic phases, price does not rise smoothly. It surges, whipsaws, and punishes weak positioning. The safest posture in this phase is to de-risk, reduce leverage, build positions you can hold through a 10% swing without being forced to sell, favor fully paid exposure, favor physical if that matches your risk tolerance and storage reality, because the entire point of owning a hard asset in a hardening world is to avoid counterparty risk, not to increase it. You also need to understand what happens when markets hit speed limits. Exchanges can impose halts when price moves too quickly. Those halts feel terrifying to anyone watching a frozen screen, but in commodity history, halts often signal that there are no sellers at current levels, not that the move is over. When trading resumes, the market frequently reprices higher to find where supply exists. If you panic sell into that moment, you hand your position to someone who has been waiting for you to blink. So here is your survival playbook. 1. Position size as if volatility will double, because it can. 2. Write your plan now, because your plan will vanish when headlines turn hysterical. 3. Do not measure success in dollars when the entire thesis is that currency purchasing power is decaying. Measure success in what your holdings can buy. 4. Watch the gold to silver ratio as a signal for when silver becomes overheated relative to gold, because historically, those ratio extremes become moments to rotate volatility into stability. And 5. Stay informed, but do not become addicted to doom, because the goal is not fear. The goal is preparedness. Now let me give you the final verdict on what is happening this week. The war premium returned because Venezuela reminded the world that resource security is no longer theoretical. The safe haven bid intensified because rate expectations and geopolitical stress converged in the same window. The Shanghai vacuum remains a structural force because Asia continues to bid for physical metal through benchmark mechanisms that reflect real demand, not just paper positioning. The banks and the derivatives complex amplify every step because stop orders and dealer hedging turn breakouts into mechanical acceleration. And the institutions are entering the year with a new mindset, because inflation risk and geopolitical fragmentation are pushing capital toward tangible reserves. But war is only the spark. The fuel is structural, and it is coming from the East. The price gap between Western markets and China is widening. Physical silver trades higher in Asia. In a normal market, arbitrage would close that gap. The fact that it does not tells you demand is overwhelming supply. Metal flows east, Western vaults drain. The so-called benchmark price becomes a discount. China is not buying out of speculation. It is buying out of necessity. Solar manufacturing and industrial expansion require silver. Factories do not stop because prices rise. They stop when metal disappears. Survival demand always overrides cost. Venezuela is also a warning to the entire resource-producing world. Mexico, Peru, Chile. When one resource-rich country becomes a target, others think about export controls and hoarding. Mexico alone produces a large share of global silver. Any threat to supply forces the market to price in scarcity. These rallies are violent because they are about access, not earnings. Gold is rising as expected. Silver is outperforming because it is both monetary and industrial. In periods of conflict, silver demand rises from both sides at once. Defense systems, electronics, energy infrastructure. War increases industrial demand, while fear increases monetary demand. Gold gets one boost, silver gets two. This is not a drill. This is a repricing environment. The charts are not leading the story anymore. The world is. If you have been waiting for a moment when the system reveals its fragility, you are living inside it. When you understand the past, the future stops being frightening and becomes predictable. And remember, the wise prepare quietly while the unprepared panic for all to see. Now I want you to comment below with one sentence. What are you doing right now to protect your purchasing power if this volatility spreads beyond metals into broader markets? And send this to someone who still thinks this is just another normal week, because normal is exactly how financial collapse begins, quietly, slowly, then all at once.